Okay, guys, shall we start? Okay. So your topic, there's another software that is loading, so we'll just let it load. Okay. All right. So your topic today is financial management. If you want, is that too much? Is it too bright? Actually, is it possible to switch off maybe one or two of the lights at the back or something like that? I don't know which one is better, back or front. You switch off a few of the lights so that it looks a little bit better. Okay. So. Yeah. Now, if you make it completely dark, then some people might just start sleeping. Okay. So let's. Okay. So let's start the presentation with. All right. So your topic is financial management. So what I will do is I'll give you some kind of to bring some structure to it. I'll show you. Mainly, I want to spend some time showing you some of the software that can be used to discuss finance. So, but we'll start with some structure to understand the role of the CFO. You know what a CFO is? Very good, excellent. So CFO is the Chief Financial Officer, and you've heard this term called treasurer? Yes. Treasurer, okay. So treasurer is also, in large companies there may be a CFO separately and a treasurer that is separate from a CFO. But in some other, we are just going to use the word CFO because it's much shorter to encapsulate the role of both the treasurer and the CFO. Okay. Okay. I don't even know how to use this actually. How do we use this? Yes. Okay, so there's a physical pointer. Okay, that's fine, no problem. Alright, okay, so let's just try and concentrate on this framework to understand. So we're trying to give we're just going to use the word CFO, the CFO and treasurer, what are their roles, and we're going to discuss it in the context of the role of the firm, and then we'll go on to looking at how two of the most important jobs, which is capital raising and risk management, how they can be done, okay? So if you look at this firm here, look at this framework here, you see the firm in the middle, okay? And what we're going to show is, so this will be a little bit in a lecture format. I won't be able to make it too interactive because you guys don't have mics, so I may not be able to hear. But if you have any question at a point of time, just feel free to ask, okay? Because it's anyway non-interactive, so let's at least make it interactive to that extent. If you have a question at any point of time, if you don't understand something, just ask. Okay, so you have the firm here, and you can see here what we're trying to highlight in the middle of the framework is that the firm is torn between two objectives, okay? On the one hand, it has to grow its earnings. Obviously, every business is set up to say make profits, okay? Sometimes you have some of these non-profit corporations, but mainly the world of business consists of companies that want to make a profit, okay? So they want to make a profit. That means we've said that we represented by this idea of growing earnings, okay? And on the other side, you also have to stay solvent because you don't want to become like Kingfisher Airlines. You know what happened to them? Right? Then what happened to ILNFS? Are you following what is happening to ILNFS? You guys need to be plugged in. You need to be plugged in more to what's going on. If you're students of business, you're BBA students, right? So how many people here who's heard of what is happening to ILNFS? Nobody? Okay, so this is not acceptable, guys. You have to be much more plugged in. You need to be following global business news, local business news, local, that is Indian business news, both global and local business news. You need to be completely plugged in. If something has happened last night in the US, which is of significance, then you should be aware of it this morning. So that is how you should be preparing yourself as a student of business. Okay. So ILNFS is an infrastructure leasing company in India, which has got into a lot of trouble because they failed to pay some installments on their debt. Okay, so they are actually now in what we call financial distress. The government has taken over the company, and Uday Kotak is managing the board, and they're trying to figure out how to make things work. So this is so this is just a message to you guys that you should be much more plugged in. Set up a Google News feed for business. It's quite easy. I'll show you some channels which you can use and track global news. So anyway, so the idea is that coming back to the framework, the idea is that you also have, when you want to grow earnings, you also don't want to end up like Kingfisher Airlines. So you have to say, you heard this term solvency. Have you heard the expression solvency? Yes. We have a new law in India called the IBC, which came out in 2016. Do you know what that stands for? IBC 2016, new law, which is one of the fastest pieces of legislation introduced anywhere in the world, anywhere in the Western style democracies around the world. One of the fastest pieces of legislation introduced from conception to implementation and the signing by the president. What does IBC stand for? Again, you should be aware of this. It's called the Insolvency and Bankruptcy Code. Okay, it's meant to deal with all these bad loan problems that the banks have in India. You're aware of the NPL problem? Are you guys aware of the NPL problem, non-performing loans that our public sector banks have? Many loans. You've heard of the Nirav Modi scandal in PNB. Okay, so PNB has all these non-performing loans they've given to this guy, effectively credit extended. Okay, so solvency means the ability to pay your debts as they are coming due. That means you have enough cash and liquid assets on hand to pay your debts as they are coming due. Okay, so that is what is meant by solvency. So what we're showing here, that the twin objectives of the firm are, on the one hand, it has to grow earnings, and on the other hand, it has to make sure that it stays solvent. Okay. Now, why I'm saying these two are actually contradictory, this requires a delicate balance, is because how do you grow earnings? Do you think you have to take more risk or less risk in order to grow earnings? More risk, right? If you can't take risk, then if you don't take risk, then you won't be able to grow earnings. So on the one hand, if you want to grow earnings, you have to take more risk. Okay. And on the other hand, in order to stay solvent, do you think it's better to take more risk or less risk? Less risk. Okay, so you have these twin objectives. On the one hand, you have to take more risk in order to grow your earnings, and on the other hand, you have to stay solvent. You have to make sure you stay solvent. Okay, and that's why you have to take less risk. So you are kind of torn between these two objectives, which are not consistent with each other. So this is a delicate balancing act that every business anywhere in the world has to manage. Okay, they have to manage this delicate balancing act, and this is where, and one of the divisions of the firm, one of the sort of functional areas of the firm that helps the company deal with these problems, this kind of balancing act, and go through its operations, is the finance function. Okay, which we are going to represent through the CFO. We're going to use the CFO to represent what the finance function does. Now you can see here what the company has to do in growing earnings. If you grow earnings, you have two ways to grow earnings. You can see the two ways to grow: organic and inorganic. Anybody knows the difference between these two? Yes? You know? Anybody knows the difference? Organic versus inorganic? Okay, I'll just tell you quickly. Organic growth is when you are just growing as your own, as your own outfit. This is the software which is actually, I hope. Actually, I've loaded so much software that my laptop might be hanging. But hopefully this will work out. So this is just some software which we use, and I hope that Okay, it is coming, so I will. Okay, guys, yeah. If you have any problems understanding me, don't switch off, okay? If you have any problems understanding me, please ask the question again and then I'll explain it again, okay? Are you guys okay there that you're facing some problems? You're okay? Okay, so organic versus inorganic, this is something you can learn from the session. Organic means you're just growing, like let's say CCD, you know CCD, the cafe coffee day chain. Okay, so CCD sets up another outlet at the Patna airport. Okay, that's an example of a new outlet at the Patna airport. That's an example of organic growth, because they're not buying some other company, they're setting up, they're just expanding their own operations. Okay, now if CCD buys Costa Coffee, that's an example of inorganic growth, because Costa Coffee is a different company. Okay, so if CCD goes and acquires, you heard of M&A, mergers and acquisitions, you've heard of that? Okay, so if they do one of these M&A transactions and they go buy a different coffee company called Costa Coffee, and that's an example. So what happens? Suppose Costa Coffee has 27 branches, okay, or 27 outlets, and CCD has, let's say, 27 outlets. So now once CCD buys Costa Coffee, now together CCD will have now 54 outlets. So suddenly their number of outlets has doubled. But this growth, so this is also an example of growth. Okay, we assume that there's some amount of sale in every outlet. Okay, but this is also an example of growth. But this we don't call organic growth. We call it inorganic growth. Okay, what is the subject in which you heard the distinction in school? Physics, mathematics, where organic versus inorganic? Chemistry, right? So this idea comes from there. That organic growth is when you are expanding your own operations without buying any new company. Inorganic growth is when you expand your operations just by virtue of buying a new company which already has some existing operations. So suddenly in this case your number of outlets is doubled. Okay, that's inorganic growth. So it is growth but inorganic growth. So obviously when you have inorganic growth, you are going to have to raise money. Okay, so we're going to try and see, this is what the company has to do, and these are some of the functions that the finance team will have to do. Okay, so obviously when you want to buy, so if CCD wants to buy Costa Coffee, maybe that particular acquisition will cost maybe, let's say, $100 million. So they have to somehow raise $100 million. If they don't have the cash in the bank, they'll have to find some way to raise the $100 million to finance that acquisition. Is this clear? So one of the jobs that the finance manager has, this is one of the most important jobs of a finance manager, of a CFO, is capital raising. Okay, so here what you're seeing is now you're starting to connect. What we're trying to do through this framework is to show you the fundamental conflict that the firm is facing and the activities that the firm is going to engage in, and then how the finance function has to perform its own duties within the larger framework of the firm to help the firm achieve its objectives. Is this clear? Are you following this framework? Okay, so this is the idea here. So you can see that as they try to do inorganic growth, the capital raising becomes an important job for the finance function. But even for organic growth, if let's say as we stick with the same example, CCD is trying to set up a new outlet in the Patna airport, then obviously that's going to require some money. So you have to give them some money. You have to lay out some cash up front so that they can pay the lease for the stall, they can buy some of the materials that they're going to need. All this requires money. So the CFO's job is also to fund what we call funding the business units. Okay, so maybe this will be part of a particular zone in Patna, some business unit within a particular zone in Patna where the airport is located. So that zone is a business unit for CCD, and that business unit will have to be funded by the CFO to make sure that they can go through this operation of putting in that outlet in the airport. Is this clear? So we say that the other function that the CFO has to perform is to fund the business unit all the business units as they go through their day-to-day operations and try to grow the business. Are you following so far? Okay, so two important functions for the CFO that we have isolated now as a result of this from this framework: capital raising and funding business units. Okay, right. Now on the question of solvency, you can see that there are a couple of things that the CFO has to do. Those yellow things are the functions that the finance function has to undertake. Two important ones: cash management and risk management. Cash management is just how you manage all your funds. Okay, all the cash that is being the cash that is being generated by the business, the cash that you have from short-term investments, how you manage the cash, where do you put it, into which account. That's called cash management. Okay, making sure your your receivables are collected clearly, early, and put quickly into the bank in liquid cash. That is all cash management. The other important thing, the very important role that the corporate treasury has to perform, the CFO, is risk management. Okay, risk management is, you heard this expression before? Okay, risk management. So risk management is completely focused on this objective of staying solvent. If you don't manage your risk, you will no longer be solvent. Okay, many airlines now in Europe, for instance, are facing the threat of bankruptcy because they have because the jet fuel prices, oil prices are quite high. Okay, so these people have, if they've not managed their risk properly, they could face the risk of bankruptcy. So risk management is completely focused on staying solvent. So two of the most important roles from this that we want to focus on in this presentation for the CFO are capital raising and risk management. Okay, so this is clear so far from this framework what the role of the CFO, what the CFO does. Now I put tax. So typically this is also a useful guide for you guys when you're going in, if you're going in for careers in business down the line, you want to do an MBA. If you're interested in a finance role, typically if you're going into a non-bank, this is the non-financial sector. This business firm that I'm showing is a non-financial firm. Okay, the same framework applies also to financial firms, but this is mainly focused on non-financial. But these guys, if you're going in for a corporate treasury kind of job, these are the kinds of jobs you will be doing, either doing funding business units, capital raising, risk management. These are the kind of jobs or profiles that an MBA will have. The one in blue, tax, legal, regulatory, that is not normally given to MBAs because you need to have an LLB or a CA or a CPA, some kind of accounting qualification. You need, for tax, legal and regulatory, typically you need professional qualifications like accounting degrees or law degrees. Only then you go in there. But with MBA degrees, you go into the areas that are in yellow. Okay, this is also for your understanding of roles. Okay, so now let's look at how risk management is done in corporations. Okay, so typically let's look at, so I should just give you what happens in the case of risk management is that companies face risks from several types of activities. Okay, one is they might have taken a loan. Okay, if a company has taken a loan, let's say a company is earning money in US dollars, okay, and but the company has taken a loan in yen. If a company which has revenues only in US dollars and has taken a loan in yen, okay, is there a problem for the company? Is there any risk? What is the risk? You guys are aware of exchange rates, foreign exchange markets, like you can see prices here. Can you see these prices here? Dollar yen. All these are foreign exchange prices. Okay. If you see, these are actually moving around. These prices are flowing. Today is a market day. So today is Friday, right? Okay. So if you notice, the prices are actually changing. Can you see that? Okay. So if you see, for instance, if we make a very short-term chart, like this data is actually live data. Okay, so you will notice that this chart will keep on changing. Now this is a very short-term chart on the dollar yen. Okay, this is the dollar yen exchange rate, which means this is actually showing this 112.20 dollar yen. Yen is the currency of which country? Japan, right? Very good. So now, as you can see, you'll notice that the chart will keep on moving because this chart is live. So these are actual foreign exchange rates that you are seeing as the foreign exchange market is open. Actually, the market trades actively between Monday to Friday, 24 hours literally. Okay, so you will see that this will keep on moving. Now what is this? This 112.20. What does this mean? Is it like 112.20? 112.2 yen per dollar, or is it 112.2 dollars per yen?
112 yen per dollar.
Very good, excellent. So this is how conventionally the foreign exchange market quotes prices. If you see, it says earlier in the first part it says USD, and in the second part it says JPY. Okay, so the way the convention is that the first one that is quoted, the US dollar, so that means that's what we call the base currency. So that means it's going to be $1 US, and then the second one that is quoted, you'll see the price. Okay, so this is the price of $1 US. As you can see here, the dollar is getting stronger in this chart also, because at the beginning of the chart here, you can see at that one point, that is just quite, this is quite recent, this is 26th October, this is New York time actually, 11:23. In New York, the dollar was trading around 112.12 yen, which means it was costing you 112.12 yen to buy $1 US. At that time, in 26th October, that is yesterday basically, in New York, it was costing this. Now suddenly the dollar has become a little stronger, because now it's costing you around 112.20. So from 112.12, it is now costing 112.2. So it is higher now, the rate is higher, which means here, because it's number of yen for $1, so now it's costing more yen to buy $1. So we say, which currency has gotten stronger, dollar or yen? Dollar has gotten stronger, because it's costing more yen to buy $1. Okay, so this is basically the idea. Now what happens is, if you have, as you can see here now, again this on the short term chart, the dollar is dropping. Okay, but if you see, there are certain parts where so if you focus on this part, let's say, if you focus on this part of the, here I'm just changing the granularity of the chart. Okay, so if you just focus on this part of the movement, okay, from here to here, where I'm moving the cursor, okay, from about this part to this part, what was happening? Was the dollar getting stronger or weaker? Here the dollar was getting weaker, right? So if you just focus on this part and see this part, so the movement is not always in the same direction. Okay, it is not always clear cut in the same direction. It is in many there are many twists and turns. Okay, as you can see, there are many twists and
So what causes the chart to change every second?
Because prices are being input. Just like when you go to a mandi, you can see that vegetables are being traded. So potato prices also do not remain the same. Onion prices do not remain the same. There are shifts in supply and demand. There's some kind of supply disruption, then onion prices might go up. So it is essentially the same thing. That it is interaction of, essentially you can see here, this is an international market. These spot foreign exchange markets are the biggest markets in the world. They trade $5.1 trillion a day of volume, okay, every day. So this is like data from a couple of years back. Earlier it was even higher, it was 5.3 trillion per day. So there's a there's a vast number of players, pension funds, hedge funds, mutual funds, corporations, okay, who are trying to hedge their foreign exchange exposure. Everybody is playing in this market, and they're combined, they're basically creating, some people want to sell dollars, some people want to buy dollars, okay, depending on their circumstances and their views. And this interplay of supply and demand causes the price to shift. Okay, so as there are market makers who are quoting prices in the market, but as their position changes and as they see that maybe today they are seeing that a lot of people coming to buy dollars on balance, because it's never going to be the same, it's never going to be equally balanced. There's always some kind of mismatch. So maybe today they are seeing, what they are seeing is that there is little excess demand for dollars. More and more people are coming to buy dollars. There's higher volume of transactions on the buy side. Okay, I mean, people want to buy more and more dollars, so this is pushing the price up. Okay, so as you know, you guys have done your economics.
Yes.
When there is excess supply, that means supply exceeds demand. What happens to the price? Price goes down, right? When there's excess supply, price will go down. When there's excess demand, price will go up. Okay, so what you're witnessing here from this kind of chart in the dollar yen market, what you can clearly see is that there is excess demand today, at least in this time frame. In this time frame, there is excess demand. Okay, so we were discussing,
So why is the leverage rate offered by trading companies higher in currency forex market compared to stock exchange?
Yeah, that is partly a function of regulation. Okay, so his question is, guys, please be quiet. When he's asking his question, is very relevant. So it's an opportunity to, every question is an opportunity to learn something new. Okay, so let's use that opportunity. Now, his question is, why is the leverage rate higher in foreign exchange markets than in the equity markets? Okay, the answer, first let's be clear about what leverage means. Okay, I don't think everybody is 100% clear about what leverage. Do you understand what leverage means? I don't think everyone, we need to clarify this concept as well. Is everyone clear about what leverage means? Not really. Yes or no? You know what is leverage? How would you define leverage? Yes?
That is the amount you can, like, if I invest $1, then I can use the leverage rate like the net. So I get $100.99 is like a loan from bank.
Yeah.
And I invest higher money using small amounts of.
Yeah. So leverage is, let's just say, if you look at leverage, essentially is nothing. There's a very similar way, there's a simple way to remember. There's a mathematical expression for leverage. Leverage is nothing but the total. I don't know if there is a pen here. There is a pen here. I'll just use the pen, or I'll try to do it on a spreadsheet so that I'll be better a little bit. So leverage is total. Leverage is basically total position value divided by. I'll have to make this. Okay, total position value divided by, okay, account equity is just the amount of equity that you have. You guys are all familiar with the balance sheet concept, equity and debt. Okay, everyone knows equity and debt. So equity is just the money that you put up, and debt is what you borrow. Okay, so the account equity, when you have trading accounts, so he's asking this question in the context of trading accounts. He's talking about why is the leverage higher in foreign exchange trading accounts as compared to equity trading accounts. Okay, so I'm coming to that answer, but before that I think we should clarify the concept of leverage so that you have a systematic and a mathematical understanding of leverage. Leverage is mathematically nothing but total position value divided by account equity. And account equity is just the amount of money that you have put up from your side in the account. Is this clear so far to everyone? Okay. So now what is total position value? This mathematical expression you understand obviously, but we have to also clarify what is total position value. Total position value is nothing but this has to be also okay. So this is leverage. So it's a little messy, but at least you are able to see better. It's better than being exposed to my handwriting, right? It's better at least you read this. Okay, so leverage, this also has to be formatted. Alright, so leverage equals total position. So now you have a systematic understanding of this. You don't have to ever forget it. Okay, so leverage equals total position value by account equity. Okay, and then what is total position value? That is also simple. Price per unit into total number of units. Okay, so if oil is trading at $80 a barrel, okay, and you have bought 1,000 barrels of oil, then your position value is how much? $80,000. Okay, oil is trading at $80 per barrel. Okay, and you have bought $1,000 barrels of oil. So your position value now is $80,000 because price per unit into number of units. Okay, in the case of oil is traded in barrels. It's not traded in grams or quintals. It is traded in barrels. Okay, so now coming back to his question. Okay, so now we understand what leverage is. Okay, so his question, essentially what he's saying is that in equity markets, the leverage is quite low, which means that compared to total position value, you have to put up a huge amount of equity. Okay, whereas in foreign exchange markets, leverage is quite high, because let's say if they let you put up $5, if they let you put up $5 of equity and control a $100 position, in this case your leverage would be, we say your leverage is 20:1. Is this clear? When your position value is 100 and your account equity is 5, so we say that your leverage is 20 times, or normally we say it as 20:1. Is everyone following? So his question, now the answer to his question, I mean long answer to his question, but I want to make sure that people understand the related concepts. So the reason that this happens is that equity markets are generally exchange traded markets. Have you heard the distinction between exchange traded markets and OTC markets? You don't know this? Okay. So maybe I'll share a video that I have, one of the classes that we have where we discuss this concept. So so exchange traded markets are stuff like NSE, BSE, all these kind of exchanges, right? The CME group. You guys have heard of NSE, BSE?
Yes.
Okay, so you need to be plugged in, and it seems like some people haven't heard of them. So exchange traded markets tend to be they're on a particular exchange, and they're much more tightly regulated by the government. Okay, and the government mandates. So the reason for your low leverage and equities is this, because the government says that it should be so. There's no reason for it necessarily to be that way, but it is that way because in most countries the governments regulate these markets tightly, and some more so than others. But it is government regulation that mandates that equity trading leverage should be quite low. Okay, and in the case of foreign exchange markets, they're actually an example of what you see here, for instance, or you can also see here. You see here what is the same stuff that you're seeing. You saw that dollar yen was around 112. This is a different software actually. Here you can see that it's moved up a little. It's the same thing, that 112.22 level, same, two different pieces of software, but the price is the same because they're talking about the same market. Okay. So here, like these things, like TSLA is the symbol for which company? TSLA is the equity trading symbol for which company? Anybody heard of electric cars?
Yes.
Tesla, right? So TSLA is Tesla has been a lot in the news lately because they came out with their earnings just a couple of days ago. So that would be an exchange traded market. TSLA, common stock of Tesla, equity shares of Tesla, they trade on exchanges. They are exchange traded markets. This stuff, this euro dollar, US sterling USD, dollar yen, these are OTC markets. These are foreign exchange markets, which are OTC markets, and you can see the prices trading here. These markets tend to be, OTC markets tend to be much less regulated. The global foreign exchange market is much less tightly regulated, and that is one of the reasons why it's the most liquid market in the world. Okay, it is so liquid and trades such high volume, but it's a largely unregulated market. So because the market is unregulated, the players can decide, okay, like this particular software that we are using, which we use for some of our projects. Now on this account here, you can actually change account leverage also. I don't know if the option is on this menu. Yeah, you see this? There's an option of changing leverage. Okay, so on this software, this is actually a foreign exchange trading software. It is provided by this company called Oanda, which is a market maker in foreign exchange. And this is actually the game software which we use for our projects. So here, everything is real except for the money in the account. That is the paper money, obviously, because it's a game software. But everything else is real. The prices are real. The news is real. So here you can change your leverage because every player in the market can decide what leverage they want to give their customers, because the regulation is quite light or lax regulation, not much regulation. So the market players have their freedom to decide what they want to do. Okay, so long answer to your question, but you have some idea now?
Yes.
Okay, all right. So we'll try to do that. We want to make sure it's very important, because I think the main reason you want to come to class is mainly to be able to ask questions. So I'll make sure that we address all the questions rather than my giving you a lecture, because everything, that's actually, if you think about it, that's the real way, only reason because to come to class. to have the freedom to ask questions, because everything else can be recorded and given to you. Okay, so we were talking about risk management, okay, and we were talking about why a company might have risk, okay, and that's when we came to this chart. Okay, so we said that if you look at this phase here, from this part to this part, okay, in this phase what is happening is the dollar is, as some of you pointed out, the dollar is getting weaker or stronger? Weaker. Okay. Now go back to the example that we gave you, that a company which has revenues in US dollars, it has revenues only in US dollars, but it has taken a loan in yen. Okay, it's taken a loan in yen. So if it has to repay, now typically what will happen when you take a loan in yen, the loan liability is fixed in yen terms because you took a yen loan. So you take a $2 billion as in B for Bombay, $2 billion loan in yen, 2 billion yen. So later on when the loan matures, you have to pay back the bank 2 billion yen, right? Then the bank doesn't really care what the dollar yen exchange rate was when you took the loan and what it is when you're paying back the loan after 5 years. Okay, the bank doesn't really care, and all it wants to do is let's go back to the weekly chart. I think we have more of a period of weak interest rates, and I can also try and open. So the bank doesn't care that whether the yen has strengthened or weakened since you took the loan. You still have to pay back the bank $2 billion yen. Okay. Now, what would happen if in that period, as you saw there, in this period again, this is suppose you do it in this period. Okay. Suppose you took the loan. Suppose you took the dollar loan. You took the yen loan. I'm trying to get my cursor. Suppose you took the yen loan here. Okay, in July 2007, when the dollar yen was trading around 123. It was trading around 123 when you took the yen loan, okay, and you have revenues only in dollars. And now when you have to repay the loan, it is now September 2011, okay, so around 4 years later. Now what has happened in this 4-year period since you took the loan? The dollar has weakened, okay, and your revenues are in dollars, okay. Now you need to buy back 2 billion yen. So now at the end of the maturity of the loan, do you need to pay more dollars for each yen? Are you able to see the situation? Because what has happened earlier, you have to flip it around actually. In 2007, the yen was trading at 123.2, right? Approximately. So you needed 123.2 yen to buy $1, okay? Another way of saying that is to say that with $1 you could have bought 123 yen. Okay? Is that okay? We can flip it around and say $1 was going to buy you 123 yen in 2007 when you took the loan. But now when it comes to time to repay the loan, what is happening is $1 is able to buy only about 75 yen. Okay? So $1 is able to buy only 75 yen. So compared to when you look at the yen amount of 2 billion yen which you took the loan for, okay, in 2007 you would have had to spend much more. That would have been equal to much fewer dollars, because with much fewer dollars you could have paid up 2 billion yen. So assuming that you borrowed the 2 billion yen, how the way it works is the money is given to you in yen, the loan bank gives you the loan in yen. And then what you do is in the spot foreign exchange markets, you go and sell the yen and you buy dollars, because you need only dollars. Your operations are in dollars, your revenues are in dollars. So what will you do with yen? You just took a loan in yen because the interest rates are low. You thought, you were very smart. You took a loan in yen because you saw low interest rates compared to dollars. So you took a loan in yen. So, but actually, when you take the loan, you sell the yen in the spot market and you buy dollars. Okay, so you got a certain amount of dollars at that point. You got quite a bit of dollars. But when you have to repay the loan, you find that $1 is able to buy only 75 yen. So compared to 2007, now you have to shell out a lot more dollars to pay back those 2 billion yen. Are you able to follow that?
Yes.
Okay, so this is what is called foreign exchange risk. This is one of the types of risk. Okay, so this is basically what is known, and this is very common it's a common type of risk that many companies face. Okay, this is an example of foreign exchange risk, and this will also give you a flavor of what is meant by risk management. So this risk has to be managed, because if you did not manage this risk properly, and the loan amounts can be very big. Okay, so suddenly you may find that you have a massive dollar shortfall because you don't have enough dollars to pay back 2 billion yen. Okay, and so your revenues are not sufficient to pay back, and then you can get into all kinds of problems. There have been cases in India also when many Indian companies who had taken loans in foreign currencies, when the loans came due, they did not have enough, they could not generate enough rupees to pay back those loans. Okay, it's the same kind of problem. So this is an example of foreign exchange risk management. Okay, and the way you have to manage this risk is that you have to look at this is a chart of the dollar yen. Okay, and I've tried to actually give you this is actually a chart of the oil price. So I could actually now flip around to make the discussion more interesting. You've already seen one example of you've seen one example of risk. We've seen an example of foreign exchange risk. Okay, now to make it more interesting, we'll move to an example of commodity price risk. Okay, so let's just briefly spend a little bit of time on the dollar yen. So how would you manage this risk? So what the company has to do, now this is where the CFO comes in and the role of the finance team. So the CFO has to be continuously monitoring the foreign exchange markets. Okay, so you can see here on this chart, you can see this is a period from about 2003 onwards to 2000 to the current date. These prices are current. Okay, that's why you see the same 112.20 kind of price. These are live charts, so these are current. These are plotted on a weekly basis here. So you can see all this movement. Can you see how dramatically it has moved? Okay, it has moved quite dramatically. So if you are not careful and you don't manage your risk carefully, you could be caught on the wrong side of this, and it could cost you a lot of money. And you have to remember, you're representing the company as the CFO, so your company might actually go bankrupt. Many companies have gone bankrupt because they could not manage their risk properly. Okay, so you can see, so essentially what the CFO has to do is monitor the foreign exchange markets, and the other very important thing that that every finance finance decision maker working in a decision maker working in a finance role has to do is you have to take a view on the market. Okay, you understand what is meant by taking a view on the market? That is, you have to take a call. You have to make an assumption that you got to make an assumption either that the dollar is going to drop or that the dollar is going to rise. Okay, that's what is meant by taking a view on the market. If I look at Indian stocks and I say I think that the Nifty will rise now quite dramatically, and then I go in and buy a whole bunch of stocks because my view is that the market is going to rise dramatically. That's called taking a view on the market. But in fact, you'll notice that it's not just in those situations, but even a CFO, while managing risk for his company, will have to take a view on the market. Okay, there's no role in finance that is available to MBA students where you do not have to take a view on the market. Everything that you see in finance, you'll notice when you study them in depth that they're all affected by financial markets. That's why when I teach finance, guys, there's too much talking, guys. Those who are not interested, guys at the back, you are with your bag, why don't you leave? We will give you attendance. Don't talk, because there are some people who are actually willing to listen, so don't create a disturbance for them. Okay, you have an attendance angle here, that if you come here you'll get attendance. Is that right? Okay, so many people have come for attendance, so why don't you, we'll give you attendance. You just sign a sheet and why don't you carry on. If you're not interested, then you sit around and disturb people. It's better if you go away. Okay, so what was I saying? I just got lost now. Okay, what was I saying? I was talking about risk management. Okay, taking views on the market. Okay, so one of the things, when I teach finance, I teach the finance electives. So the entire teaching of the elective courses in finance is heavily focused on financial markets. And there's a reason for that. The reason is because we are trying to develop the skills that the students must have in order to be effective in their roles in the finance function. Okay, and in order to be effective, you need to have not only theoretical knowledge, but you need to be very comfortable with taking views on the market. Okay, taking views means just taking a position that I think that oil prices are going down, or I think that oil prices are going up. Okay, this is a very definite view. Do you understand that? That means you're taking a very definite position. If you say oil prices are going down and if you sell oil, now then if prices go up, then you're going to be in trouble because you've already sold. So there's a risk involved, there is uncertainty because no one really knows what's going to happen. But even in the face of uncertainty, in order to do your role properly, in order to perform your role properly, you have to take a view on the market and you have to take a decision based on your view. Are you following? Okay, this is what is required. So therefore the teaching of finance is very focused on financial markets. That's why you guys need to be completely steeped in financial markets. You need to know what's going on and develop a feel for the markets. Okay, so essentially what the CFO will have to do in the case of foreign exchange risk, he will have to monitor the foreign exchange markets continuously. Okay, and he will have to take a view on the market, and if he feels that the dollar is going to drop sharply against the yen, he will have to go and hedge that risk that he has. What happened? We are running out of time. Okay, so the CFO will have to take a view on the market. If he feels that the dollar is going to happen, is something like this is going to happen, if he feels that we are at this kind of situation where the dollar might drop against the yen, if he feels we are somewhere here, then he will actively go out and take out a hedge position against the exposure. Okay, this is where you need to understand what a hedge position is. Okay, you know what a hedge position is? A hedge. Okay, so in order to understand what a hedge position is, you have to first understand what is an underlying position. Okay, so the hedge position actually is kind of opposite to the underlying position. I'll try to just pick up the notes and so the underlying position essentially is just the position that you have as a result of your business activities. Okay, and one of the business activities that you have done here is that you have taken out financing in yen because you thought that yen interest rates were so low compared to US dollars. So you got, great, I've got cheap financing, let me take out a loan of 5 billion yen. So you've done that, and then okay, so the underlying position essentially is, there's a lot of detail here, but I'll just give you an idea. It's nothing but what the exposure that you have, okay, the position that you have because of if your natural business activities. Okay, your natural business activity in this case has been to borrow yen. In this case you have borrowed yen because you thought yen interest rates were low. So in this case you have a position in the dollar yen market, which is you're actually short. If you're long dollar yen, okay, you're long dollar yen. You understand the difference between long and short? Do you guys understand long and short? Long dollar yen means you have bought dollars and sold yen. Look at this transaction. Is everyone getting confused here? Are you following? Is this discussion making sense to you so far? Is it making sense? Okay, so we'll continue. So what I'm going to do is, instead of focusing on covering a lot of material, I'll just try to make sure that we cover some material, we cover it in depth and address all the questions around it. Okay, so you notice something here, all of these things, especially the currency markets, I'll come to the others later, but you see here, it's all, there are two currencies. Can you see that? Dollar and yen, there are two currencies. Okay, then here there is Aussie versus AUD is which currency? AUD is which currency? Australian dollar. Okay, all right, so Australian dollar, then EUR is which currency? Euro. Okay, so you can see they're all given in pairs. Okay, they're all given in pairs. Okay, so essentially, which we see, think about any transaction that you do, it'll clear things up very quickly. When you go to the market and buy sugar, okay, are you trading in, is there only one asset involved? Is it just sugar that there is there's a transaction, right? You go to the market and you buy 1 kilo of sugar. Okay, so in this transaction there are two assets involved. There is sugar, and what is the other asset? Sorry? INR. Somebody said INR or rupees, right? Because what is the trade happening? You are giving him some rupees, let's say 50 rupees, and you are getting some one asset on the other side, that is sugar. You are getting a kilo of sugar and you are giving him 50 rupees. So actually the two assets that are being exchanged here is, one is sugar and one is Indian rupees. Okay. So typically what will happen is the same kind of transaction is being done in Tokyo. Okay, local market in Tokyo. Then you would be exchanging sugar against what? Japanese yen. Okay, because they will not be trading in rupees, they will trade in Indian Japanese yen, local currency. So the idea is here, the fundamental idea here is that you have to think of every transaction as involving two assets. In any market, every transaction, whether they mention it explicitly or not, okay, here in the currency markets you can see they have explicitly mentioned AUD USD, Euro GBP, okay, or USD JPY, okay, Euro JPY. Here they have mentioned it specifically, but whether they've mentioned it specifically or not, every transaction involves two assets. You are always buying one and selling the other. Is this clear? In every market. So in the what we say is, the terminology that we use is that in any market, whatever is the unit that is being traded, okay, whatever, like in this case you can see here the asset that is being priced is actually dollars in the dollar yen case. In this dollar yen case, you see the price is moving around continuously. The price, what is actually changing is, this is what? This is $1 equals to some amount of yen, okay, variable amount of yen, and that variable amount is continuously changing, okay. But that $1 business is not changing. It's always $1 on one side. It is only the price that is changing in terms of yen, okay. So the expression that we use here is base. We use the expression, we can use this general expression. One is base asset and one is terms asset. I can just write it here to make it we can use this expression okay. So now very basic market knowledge, okay. So we can use the expression base asset and terms asset. So in the case of this, coming back to the dollar yen example, you see that the $1 part is never changing, okay. It is always the price of $1, but how much to pay for $1, that keeps changing. Sorry. Okay. Because I have a tendency to shout, so my throat goes for a toss. So the point to understand here is, as we come to the idea of underlying position, we have to get some basic knowledge of markets. The way that any market anywhere in the world functions is, a market is like a venue to exchange assets. That's a way of thinking about the market, of any market. And you always exchange two assets, one asset for another. Okay, so you're exchanging sugar for Indian rupees. Here you're exchanging dollars for yen. You're exchanging dollars for yen, and always there's one side which is never changing. Here the $1 part is never changing. So the part that is never changing, we call that the base asset. So in the dollar yen market, we will say that the US dollar is the base asset. And because, how is the US dollar here in this market? The US dollar is being priced. We say that the US dollar is being priced. How is it being priced? In terms of yen. Okay, like we go to buy a sari. How is the sari priced? In terms of rupees. Some are 2,000, some are 6,000, some maybe 15,000. Okay, they're all saris, but they are differently priced, and they're all priced in terms of rupees. Okay, so this is the idea. So the terms that we use, base asset and terms asset. Okay, base asset and the part that is never changing, that is being priced, that's called the base assets, kind of, because it's kind of like the base, okay, the foundation. So that is more fixed, okay, and that we call the base asset, and the currency or the unit in which, or the asset in which that particular base asset is being priced, in terms of which it is being priced. So it's easier to remember terms asset because the dollars are being priced in terms of yen. Sugar is being priced in terms of rupees. So that's why we'll call the rupee the terms asset. Okay, so if we have this basic general conception, you can see any market anywhere in the world, doesn't matter what you're looking at, will always have two assets. There will be an exchange of two assets. and then you can call one of them the base asset and the other one the terms asset. Okay. So the point to notice is in the currency market notation, you can see the last currency market example, USD NOK. NOK is which currency? Any guess? Scandinavia? Norwegian krona. Okay, the currency is called krona. So NOK is Norwegian krona. Okay, so in the case of currency market quotations, you will see that both the assets are mentioned. Okay, but what about copper? What about gold? What about oil? Can you see those markets there also trading? Can you see them as well? Those prices. So they have not mentioned any other asset because copper is only one asset. Gold is also only one asset. Okay. Oil is also only one asset. So what is the other asset in those markets? Any idea? Let's pull up one of those charts. Let's take oil. Okay. Now what is happening to oil? What does this mean? The oil chart, this is the US crude oil price. West Texas Intermediate is a grade of crude oil in the US markets, in the North American market. In America, it's a US market basically. So what does this mean? First it was around 66.90. Now it has come to 66.65. What is this business of 66.65? What is it? These are the prices of oil. Okay, I already told you something earlier in the course of some other discussion that oil is priced in what? Barrels. Okay, oil is priced in barrels. So that means we know that. So here, what do you think the base asset is in this market? Anybody, any guess? What is the base asset? Oil, okay, oil is the base asset and the unit is, I already told you, is 1 barrel. So whatever you're seeing is the price of 1 barrel, okay, of oil, okay, and in particular West Texas oil. But what is the terms asset? What do you think it is? Anybody wants to guess? Is oil a major internationally traded commodity? Is it a major globally traded commodity, like you make it in Saudi Arabia, Norway, and you ship it to buying countries like China, Japan, India? It is going all over the globe. Okay, it is being globally traded. So what do you think? What is the terms asset? Do you think the terms asset is likely to be everything is bought in terms of some currency? I said in yen. In Japan, when you are buying sugar in Tokyo, you are paying in yen. So in the case of oil, what currency do you think people are using? Okay, so the answer is US dollars. Okay, safe bet. Whenever you are looking at any internationally traded commodity, okay, the US dollar is the most dominant currency in the international markets. Okay, the US is by far the most dominant economy in the world. Okay, no economy comes anywhere close. Okay, all this hype you hear about China, India, Brazil taking over the United States, it's all rubbish. It's not going to happen, and even in your lifetime. Forget about my lifetime. No way it's going to happen. Okay, so the US is the most dominant country, and so everything is as a normal safe guess. Any globally traded commodity terms asset is going to be US dollars. Okay, so all these 3 commodities that I've shown you, copper, gold, and crude oil, they are all globally traded commodities. Okay, they are all traded in US dollars. So the other thing, so one thing we learned is that in any market, a market is like a venue for exchanging assets. Okay, and any market we can define a base asset and a terms asset. Okay, and in the currency markets both are being mentioned, but in the case of other markets like crude oil, copper, some of the commodities markets we see sometimes, and even the equity markets we see that the terms asset is not being explicitly mentioned. But that does not mean that there is no terms asset. There is always a terms asset. You cannot have a market without a terms asset. Okay, because there has to be an exchange. Otherwise you're just giving oil away for free. You want something in return. Okay, so therefore there is always a terms asset, and you need to know, you need to have contextual knowledge of the market concerned to understand what is the terms asset. So when you go back to the example of crude oil, the terms asset is US dollars. So here what is happening is 66.90 US dollars per barrel. Now it has come down to 66.65 US dollars per barrel. Okay, this is how the price of oil is fluctuating. You can see how much it fluctuates. Okay, and this is also a very important commodity for India because we are severely affected by oil prices. Okay, you're aware of that? That right now we have a big budgetary problem because of the oil price rise in the oil price. Okay. So again, another example of we are discussing the concept of risk management. Okay, that's why we came to this market. Okay. So here, if you see, now let's go back to one more. Yeah, let's give you an idea about oil prices. Okay, this is another chart of oil prices. I'll just blow this up and to give you an idea of. Okay, I can't without my mouse. Hard to make this move around, but you can see actually you can get some idea about the volatility of oil prices. You can see that. See, it has gone from 2004 around $30. Okay. To about 100, this went to about $148. Okay, you can see how sharply it rises, and you see how sharply it falls. Okay, these are all real prices. I didn't draw these charts. These are all real history. How oil prices actually move. Okay, so this is how it moves, and this is where it is now. This is where we have problems now because it has gone up so much. Okay. All right. So this is an example of oil prices, how volatile they can be. Can you see how it is changing so rapidly? Changing so rapidly means that it's always going to create risk because some people will be on one side, some people will be on the other side. Okay. So let's look at it from this point of view now. If you look at it from India's point of view, okay, what is good for us? Oil prices falling or rising?
Falling.
Falling is good for us. Okay. So in this case, we see. And you guys said you already understood what is meant by long and short. You understand what is meant by long and short, right? Long means you have bought something. Short means you have sold something. Okay? You have essentially, now we know the terminology of base asset and terms asset. Long means you have bought the base asset. Okay? And short means you have sold the base asset. And remember, it's an exchange. So whatever you have done to the base asset, you have done the opposite to the terms asset. When you went to the market, you bought sugar, and you can think of it as you sold rupees. You bought sugar and you sold rupees. So it's always opposite. Whatever you do to the base asset, opposite is being done to the terms asset. So if you have sold oil, that means you have bought what? US dollars. Okay. You've sold oil, you have bought US dollars. Okay. So this is the situation this is what we roughly mean by long and short. There is actually a more advanced definition which we need not bring in at this stage. Here we have your long and short is very clear. Short means sale of base asset. Long means purchase of base asset. Okay. Now what we see is, if you look at, I'm just going to. Because without my mouse, I'm not able to manipulate this. Okay. Let's look at this now. This period now, you can see here this period. Let's focus on this part. Okay. This part from 2017, about June of 2017 till today. Okay, a lot of significant increase in the oil price from about $42-43 to a high of about 77. Okay, this dramatic increase in the oil price, is it good for India or is it bad for India? Bad for India because we are paying more and more rupees. And on top of that, you're not seeing the other part of the picture, which is the other part of the picture is this. Remember that when you're looking at a country like India, so oil is traded internationally in terms of which currency? US dollars. Okay, but our currency is not US dollars. So if we want to buy oil, okay, we have to look at one more thing. What is happening here? Is this good news or bad news? This is also bad news. Okay. So because what we have is rupees. What the government of India has is rupees. What HPCL, BPCL, IOC, ONGC, all these guys, what they have is rupees. Okay. They have to use these rupees to buy oil. So it is like a two-step process. First, they have to use the rupees to buy dollars. Then they have to sell those dollars and use that to buy oil. Is this clear? So it's a two-step process for us. Okay. Now what is happening is you are getting hit on two fronts. You are getting hit because the dollar is getting stronger against the rupee. So for each rupee you can buy fewer and fewer dollars. Is this clear? Each rupee buys you fewer and fewer dollars. Is everyone clear about that? Because each dollar is buying more and more rupees. Okay, it used to be earlier so much less. Okay, 42 and 39 and all that. In 2008, okay, it was $40. and now it is now 75, okay, nearly $75. So each dollar is buying so many more rupees. That means the flip side is each rupee is buying less and less dollars. Okay, so now when we go to buy oil, when IOC goes to buy oil, we are stuck, we are getting hit on two fronts. Each rupee is buying less and less dollars. And on top of that, what is happening to the oil price? The oil price, we are just focusing on this part, okay? For our discussion, we are only focusing on this box, okay? These are all charts. These are all charts of the oil price, but showing different periods, okay? I mean, the starting period is different for all the charts. The ending period is the same. Okay, so now you can see here what is happening in the third chart on the top, okay? Is that in that period, what is happening to the oil price? Is it getting stronger or weaker? Stronger, okay? Because each barrel of oil requires more and more dollars to buy, okay? So therefore the oil price is getting stronger. So therefore now we are getting hit on two fronts, okay? So therefore this is what is happening. So this is what is meant by, now in this case, let's think about it. So as we want to discuss the idea of underlying position, right? How do we understand what is the underlying position? And now I'm going to ask you this question of what is India's underlying position in terms of oil, okay? But before that, let's understand this, to understand the answer to that question. So when oil prices go up, it's bad for India, and when oil prices fall, it's good for India, okay? This part was good for India. This price, when oil prices were coming down from about over $110, came down all the way to about $35, okay? This was good for India, okay? So India is in a situation where, and we didn't do anything about it. It's just that in our country, we don't have oil like Saudi Arabia and Norway and all these Kuwait and all these people, right? It's just bad luck. You can think of it as bad luck, okay? So in this case, but India's situation is such that when oil prices go down, it is good for us. When oil prices go up, it is bad for us. We can say we are losing money. And when oil prices are falling, we are making money. We can say that, okay? Now if I ask you, what is India's underlying position with respect to oil? Because remember, position can only be long and short. Position is either long and short, either you're long something or you're short something, okay? Position is either long or short. So if we ask you the question of India's underlying position in oil, is it long or short? It's long. Why? Okay, think of it this way. If you go long, okay, if you go long and then the market declines, if you go long, let's say you go long crude oil. If you go long crude oil and then the market rises after you go long, let's say you go long at this point. You go long here at $45. At $45 you go long crude oil, which means you have done what? Bought crude oil and sold US dollars. This is clear? Okay, after you go long, the crude oil price rises. So now are you making money or losing money? You went long at 45. You bought crude oil and sold US dollars. Then after that, the crude oil price keeps on rising. So at this point, when the price goes to 77, are you making money or losing money?
Losing money.
You're making money, because now for each, let's say even if you bought $1 of 1 barrel of crude oil, you bought it for $45, and that which you bought for $45, you can now sell for $75, so you're making money, okay? So now understand the characteristic of a long position. What is the characteristic of a long position? That if you are long the base asset in any market, remember we have understood markets, exchanging two assets, venue to exchange assets, two assets, a base asset and terms asset, okay? Now what we have seen is that in any market, and long means purchase of base asset, short means sale of base asset, and just now you've seen that if you bought the base asset, and after you bought the base asset, which is crude oil in this market, then the market went up, and now you're making money. So what is the rule that we can derive from this? That if you go long and then the market rises, you make money. Everyone, I don't think everybody is clear about this. Is this clear so far? That if you go long, you have purchased the base asset, and then after you go long, if the market rises, if the market price rises, then you're making money. So the reverse will apply at this stage. If you had gone long at $100, okay, on the oil price, on this chart, second panel, and then the market price dropped to $35. Now what is happening? Are you making money or losing money? Now you're losing money, okay? So we can see this rule that is developing, that if I go long and then the market drops, I lose money. If the market rises, I make money. If the market price rises for a long position, so the characteristic of a long position is that when the market price rises, it makes money, and when the market price drops, it loses money. Is this clear? Okay, now come back to the question of what is India's underlying position. Okay, and because we are talking about position can only be long or short. Okay, so the position can only be long or short, and I'm asking you this question, and you know what India's situation is. You know what happens to us, whether we make money or lose money when prices fall, and whether we make money or lose money when prices rise. You know all that information, right? So now if I ask you, what is India's underlying position with respect to crude oil? In the crude oil market, is India long or short? Some are saying long, some are saying short. Okay, let's see both. Let's test both sides. Let's test both sides. Okay, so let's assume that India's underlying position in crude oil is, remember, underlying position is that which you have without really doing anything much, just as a result of doing your business, going about your business. Okay, so we were there as a country. We just so happened God didn't give us that much oil. Okay, gave most of it to Saudi Arabia, Venezuela, and all these countries. So this is where we are, and that's our underlying position has already been determined. Okay, in the case of crude oil. So now work back the situation. If crude oil, you're saying somebody said long, India's position is long. Now what did we do? What is the rule that we derived? If our position is long in any market, when the price rises, we should what? Make money or lose money? We should make money. So test it for India. When the oil price rises, does India make money? No, it loses money. Okay, and then the other thing about long position is if the price falls, you should be losing money. So when the price falls in oil, does India lose money? It's making money. So long cannot be the answer. So then must be short, right? If it's not a boy, then it must be a girl. So if it's that, we now test it out for the short side. If India's underlying position in crude oil is short, then what should happen when the market rises? We should lose money, because short position means when you go short and the market rises, you lose money. Is everyone following? You're getting tired. You're following the logic? That when the market rises, if you have a short position and the market rises, then you lose money, and you have a short position and the market falls, you make money. So now what is happening in India's case? Is it matching this? When the market falls, we make money. When the crude oil price falls, we make money, and the crude oil price rises, we lose money. Is this clear? This much everybody knows. So that means India's underlying position must be short. Are you following the logic? So you don't memorize the stuff, you work it out logically. The only thing you memorize is that, and that also you can work out logically again, that if you have a short position in any market, when the market price rises, you will make money. When you lose money, and if it falls, you will make money. If you are long in a market price rises, you make money, market price falls, you lose money. Okay, and then you have to have the knowledge of the particular country that is being discussed. Okay, you need to know that India is a net importer of oil. You need to know that Mexico is a net exporter of oil. Okay, so therefore Mexico's underlying position with respect to crude oil will be long. Okay, because India is short. So you can reply the same logic, but shorthand you can quickly make. So what is Saudi Arabia's underlying position with long? Okay, so this is the point. So that we were discussing risk management and hedge position, but to understand hedge position, you have to understand what is underlying position. Okay, so underlying position is basically this kind of a situation where without really doing anything actively, okay, you have actually, as a result of your normal business operations, you have some exposure to the oil price. You can't help it. You didn't really want to be exposed to the oil price, but you are. So this is what is meant by the underlying position. Okay. So now if you think of hedge position, the hedge position basically has to offset the underlying position. Because think about it. Basically what happens is, in this case, if you think about it now, let's think of it from the point of view of an airline. Let's think of it from the point of view of an airline. Okay. An airline has to use jet fuel. You know that? Okay, jet fuel is like kerosene. It's a derivative of crude oil. Okay, it is produced by refining crude oil. Okay, so it is the price of jet fuel is very closely related to crude oil prices. Okay, we can show you a chart where you can see how closely they are related. Are you guys getting tired? I understand that we also have to look at the fatigue factor. We have been discussing for how long now? We have only 10 minutes left. You need some of that time? So how much time do you need? Okay, you're giving me 10 minutes, fine. So we will try to at least cover the concept of hedge position so that you will understand one aspect of a corporation. So you guys can manage another 10 minutes? Okay, alright, good. So here's a chart which is showing you the crude oil and the jet fuel price. Okay, the relationship between the two, you can see that they're quite closely related. Can you see that? They're quite closely related, but they are not exactly the same. You can see sometimes the difference is getting very narrow, like here. Here the difference is very narrow, but again somewhere like here the difference is very wide. Okay, so they are quite closely related. To understand to explain this, because we have limited time, we are just going to make an assumption that airlines have exposure to the crude oil price. Okay, we are just going to make it simple. But the jet fuel price is very close to the crude oil price. It's a derivative of jet fuel. So crude oil, you make it in the refinery. So jet fuel is actually it's what you need. It's called ATF, aviation turbine fuel. Okay, so this is what you need to fly an airplane. And jet fuel, as a general fact all over the world, that jet fuel expense is about 50% of the operating cost of any airline. Okay, 50% of your operating cost is jet fuel expense. Okay, so it's a very big factor in their costing and your expenses. So the airlines have a huge exposure to jet fuel prices. Okay, so what we want to do is, and in this case now in the case we just remove jet fuel and we'll talk about crude oil. We say that they have a huge exposure to crude oil prices. Okay, so what is again? Let's discuss the underlying position of an airline with respect to crude oil. Use the framework that I just gave you. That you know what is happening now. If the 50% of your operating expenses is coming from jet fuel, okay, is crude oil. We're going to just say crude oil. Then if crude oil prices go up, is that good for you or bad for you? Bad for you. It's like you're losing money. Okay, it's straight simple maths, because your expenses are going up. If revenues don't change, your profit is going down. Okay, so you're losing money straight out. So if oil prices rise, the airline is losing money. And if oil prices fall, your expenses are going down, so airline is making money. So now answer this question: what is the airline's underlying position with respect to jet fuel or crude oil? Yeah, they're short. Their underlying position is short. Clear to everyone now? So this is true for any airline anywhere in the world. Okay, any airline anywhere in the world, you can just say that you can just close your eyes and say that their underlying position is short jet fuel or crude oil. Okay, if you want to use crude oil as a proxy for jet fuel. Okay, so now comes the question of hedging. Many airlines, you'll see, they have a very active hedging program. Now what are they going to do in the case of hedging? What they're going to do is this. They are looking at this crude oil price. Okay, they're looking at the crude oil price and they're taking a view on it. Okay, suppose an airline decides that even here at this point, let's just use this chart, when the price is around $75. Okay, if the price keeps on, now there's a lot of talk in the market because of the sanctions on Iran, okay, other supply disruptions, the oil price might go to $100 a barrel. Okay, there is a discussion in the market. So if the airline feels, let's say take Singapore Airlines, okay, Singapore Airlines, if they feel that the CFO, let's say now the CFO of Singapore Airlines feels that there's a serious risk that oil prices can go to $100, maybe even $110 a barrel. Okay, so that's not going to be good for them because their underlying position is short jet fuel. Okay, now what he's going to do, this is where hedging comes in. What he's going to do as a hedge is, he's going to do something. He's not going to disturb his underlying position. Okay, he can't change his underlying position. But what he's going to do is on the side or in parallel to the underlying position, he's going to set up some other position which will help to offset his losses. Okay, because if crude oil prices go to $110 a barrel, obviously they are going to lose a lot of money in their operations. Okay, but he wants to do something as a hedge so that on the operation side he will lose money, but on the hedge position he is going to make money, so that the money he makes on the hedge position will offset the losses on the operating side. Are you following the scheme? Okay, you want to set up some kind of offset. Okay, so this is what hedging is all about. Hedging, you can just remember one word, is about offset. Okay, you want to offset what is there in the underlying position. So what you do as a hedge position, what the CFO of Singapore Airlines will do as a hedge position is he's going to go and buy crude oil futures. Okay, don't worry about what our futures contracts are, but basically he's going to just go into the crude oil market. Like you can see this crude oil market, it's trading here 68, 66, 63, 66, 66. Okay, this is the price. He's going to go into the crude oil market and he's just going to buy a bunch of crude oil. Okay, let's say we just do a buy. We'll do a market buy. Okay, so just as an example, let's say I'll do 1,000 barrels of crude oil and I'm going to just buy it. Okay, and then it says order executed. So now if you see my position, I do have long. I already had a long barrel, 100 barrels. So you can see here I have long position of 1,000. So what this thing is now, what will happen now? This particular transaction I did, this is my hedge transaction. Okay, this is my hedge transaction as CFO of Singapore Airlines. I just went and bought some crude oil because I'm afraid that prices will go from 75 now to about $110, and I'm going to lose a heck of a lot of money in my operations. So I want to do something that will offset that. I need to do something that will make money if oil prices rise. So what do? I go into the oil market and I buy a bunch of oil. Okay, that's what I just did. So what will happen now if my view turns out to be correct and the price indeed does rise from 666 to $110? Of course, I'll lose a lot more money in my operations. Okay, my day-to-day operations. But on this position, I'll make money because I just bought it at 66 something. So what will happen is this will offset whatever money I make over here is going to offset what I lose in my operating business. Okay, so this is the idea behind hedging. So what I've just done is I've hedged a part of my underlying position exposure. Okay, that I have at least set up some kind of a hedge position which will benefit if my underlying position loses money. So it will offset, and therefore on a net basis at least I'll be better off. Okay, if you want to go 100% hedged, then you will be 100% locked in and you will not lose any more money. Okay, many airlines is a real business decision for many airlines. There's an airline in Europe called Ryanair. I don't know if you've heard of it. It's a low-cost airline but very successful. Okay, there's an Irish airline. They actually have sometimes they hedge 3 to 5 years ahead for all their operating purchases of jet fuel. They know how much of they're roughly going to buy. They hedge all of that to 5 years, 3 years out, so that they have certainty. Now they know that my net purchase cost of jet fuel. See, what has happened is, if let's say the airline was only going to use 1,000 barrels of oil, okay, it was only going to use 1,000 barrels of oil, just as an example. Now I just bought 1,000 barrels at 66. What is the price? The price is not given, but here I can see it here. So yeah, I bought it at 66.671. Okay, so if my operating business also required only 1,000 barrels of oil, that means what I've done is, for all my future oil, for my next year's oil purchases, which is only 1,000 barrels, I have locked in a price of 66.671. Now I will not lose any more money on a net basis, because if it goes up from here, the underlying business will lose money, but the hedge position will make money. So on a net basis, I'm okay, I'm balanced. Are you following this logic? So this is basically what hedging is about, and this is what a CFO of a company has to do actively, because otherwise you could lose a lot of money. Okay, like earlier when this oil price went, like this time that you're seeing here, when prices went to here, when prices went to $147 here in 2007 and 8, when it went up like this, many airlines went bankrupt because they just did not expect that kind of price in oil. Okay, and obviously as oil prices go up, jet fuel prices also go up. Okay, you saw that chart. You can see the same thing here, 147 on the crude oil price, and jet fuel prices also go up. Okay, because it's derived from crude oil. It's like if you have if milk prices go up, then yogurt prices will also go up. Okay. So this is what hedging is all about. This is how you set up and offset and protect your underlying business. Okay. So this is one of the most important roles of the CFO: hedging, risk management. This is what hedging, risk management is basically your hedging, understanding your exposure and hedging that exposure. And you can see here, it again requires you to take an active view of financial markets. Okay. So I'll just give you guys a couple of quick tips. I still have time. Very quick tips, because I was a little bit concerned about. Are you guys motivated or not? You guys are motivated. You don't mind working hard. Okay, good. Because if you don't mind working hard, then you're in trouble. Okay. So what you should set up is just set up a Google News feed. Okay. Now I need to get small here. On the left hand side, you'll see a menu, and you can choose business. Okay. Here it's there should be here there's a menu on the side called business. Choose this business. This will just look at it every day, read what is happening in the world. Okay, what is happening in India. This is mainly Indian stories. Read this. Okay. Another thing that you guys should read is this thing called Bloomberg Quint. Okay, this gives you some kind of international markets also, and mainly it's an Indian market focused website. You can read this Bloomberg Quint. Then you can just make a note of this. Just type Bloomberg Quint. Another thing that you should read is Reuters.com. This is for international news. Reuters. So you should be absorbing the idea, guys, is like this. Every day you have to bombard your brain with all kinds of stimuli, and all this news is just stimuli. Okay, that Tesla came out with earnings, production numbers are not on schedule. Okay, there are a lot of production problems, spare parts problems. This is all news. You have to bombard your brain with news, and eventually you will see that even if you don't understand anything, it doesn't matter. You bombard your brain with news every day as a matter of duty. Okay, eventually you'll see after 6, 7, 9 months, your brain will start to make sense of things, because nobody is stupid. Your brain will start to make sense of things, but you have to give it time. If you give up on day 1 or day 2 because I'm not able to follow anything, then the game is over. You have to keep pushing. You have to bombard your brain every day. Reuters.com is for global news. Bloomberg Quint and Google News Feed is for Indian news. Okay, there you'll see connections to Economic Times and all that. Another thing you should do, very easy, global perspective. Remember, in most business schools in India, we teach from an Indian perspective. That's not correct. It's a globalizing economy. Your right perspective is first global perspective. Then India becomes a part of that global perspective. Of course, you have to have in-depth knowledge of India because you're operating here. But the perspective should be global to start with. So go to YouTube. I hope you guys remember all this stuff. Okay, go to YouTube, then search for search for this thing called Bloomberg Live. Search for this thing called Bloomberg Live. This particular channel is one of the best business channels in the world. Only thing you have to understand, they're quite anti-Trump. So when you see them covering anything done by Trump, and if they say it's very bad, then you know it's not actually very bad. It's probably just about okay, but these guys have an anti-Trump bias. So you have to understand, and there is no such thing as objective media. Everybody's biased. You just need to know which side they're on. Okay. So go for Bloomberg Live. Go to Bloomberg Global News, and you'll see this 1.1K watching. You'll see this live now link. You see the live now link? Click this. This is very important for global markets news, global financial markets focus, but they cover everything. Okay, they cover. Now there's this company called Altran Technologies. This must be a European company. Their earnings must have just come out, so they're interviewing the CEO. Okay, so you can see this. So this stuff, this channel is available, one of the best business channels available 24/7. On the weekends when markets are not open, they have very nice coverage of technology. They'll be interviewing people in Silicon Valley. Okay, you must listen to this channel at least 1 hour every day, preferably during New York time. In your evening time, instead of watching Big Boss and other stuff, you watch this. Okay, while having dinner, watch this. every day, and every day watch CNBC TV 18 or Times. Now CNBC TV 18 is the best channel actually. Watch at least 1 hour of those of that channel and at least 1 hour of this every day. Make sure you bombard your brain with global business information non-stop. Okay? So there needs to be a lot of improvement from what the situation is right now. Is this clear? Okay, I think we can stop now. I've given you so you can see all this stuff. And as I said, one more thing, as you listen to all this, don't get disheartened if you can't follow anything. Today you will follow only 1%, after 6 months you'll follow 15%, after 1 year 35%, and that's how it will improve. So you have to have that confidence. If you just give up because I'm not following, then everything is lost. Okay, so we'll call it quits here, guys. Okay, now you can come. You can come and start talking.
Switch on the lights.
Yeah, switch on the lights. Can someone switch off the projector also? You can keep speaking.
I hope you guys have received one feedback form. So kindly put on genuine reviews that whether you like the session or not. If you wanted to go for some more session on different topics, then kindly mention the topic as well. So that in the future your whatever the HOD is, they can organize such type of sessions.
The person would come, he wants to meet each other and share his number. And get the number of each other.
So, sir will come, or the Bacha will come to have a conversation.